Is investing in Central Coast a waste of time in 2025? Plenty of investors are writing off Central Coast right now. They're saying prices have peaked, yields are weak, and the region's best days are behind it. But before you walk away, here's a question worth asking. Have you actually looked at the data? I'm Gilbert Melgar, a data analyst, property investor, and founder of SuburbsFinder. I have built a property and research analytics tool to help investors find the best locations to buy based on their goals. When I ran the numbers inside SuburbsFinder, I saw suburbs on the Central Coast with vacancy rates between 1.2% and 1.4%. I even identified suburbs with yields above 3.5%. Buyer activity seems to be holding strong, and stock levels are low across the board. So no, it's not a market in decline. It's a market that's recalibrated. And if you understand where the pressure points are, like affordability, vacancy, and future rate cuts, you'll see exactly where the next opportunities are likely to show up. So let's break it down. Before we get into what's working, let's start with why some investors are pulling back from the Central Coast entirely. Prices are up, returns are down, and growth has stalled. That narrative isn't wrong, but it's also incomplete. So let's unpack the 3 reasons shaping that perception. Firstly, let's tackle some of the affordability concerns. Prices in some suburbs across the Central Coast have jumped around 80% since 2019. Suburbs like Gosford now sit at around $1 million, Wyong at $845K, and Killarneyvale at $920K. These areas used to be affordable options, but now, if you're local residents, you're looking at roughly 35 years to fully pay off a property. That's a big psychological barrier for a lot of buyers. Secondly, there's the plateauing price growth. In 2023, the market saw a significant downturn, although it did bounce back slightly in 2024. But high-end suburbs such as Pearl Beach, Foresters Beach, and Avoca are noticeably slowing down. Properties here are taking about 60 days to sell, indicating that buyers in premium areas are cautious or hitting borrowing limits. Lastly, rental yields. This is a big one for investors. Some areas, especially the high-end ones, are returning yields as low as 2.66%. Places like Point Frederick and McMaster's Beach are closer to 2.3%. That's tough to justify in a high interest rate environment. But you should keep in mind that the Central Coast is not one single market. It's a collection of more than 50 suburbs, each moving through their own microcycles, shaped by infrastructure plans, proximity to employment hubs, affordability dynamics, and demographic shifts. Yes, the premium suburbs are cooling. But if you zoom in on some of the mid to low tier suburbs, you'll find ones where the days on market are already back to between 32 and 39 days, and where their yields are holding between 3.85 and 4.09%. So let's take a look at some of the more positive signals emerging from the Central Coast. Firstly, let's talk about supply risks. It's actually surprisingly low. Upcoming supply data from SuburbsFinder shows manageable stock levels across the Central Coast, with current stock on market percentages ranging between 0.6% and 2%. This is a good thing because a low stock on market percentage indicates that there aren't many properties available relative to the size of the market. When there's limited supply, buyers compete more strongly for available properties, which typically supports or pushes prices upwards. And with development approvals declining, there is a reduced pipeline of future housing supply, which could potentially put upward pressure on prices. Vacancy rates are another key indicator, currently hovering around 1.2% to 1.6%. Low vacancy rates indicate a very tight rental market. This is good news for property investors because it means there are fewer available properties than renters seeking accommodation. As competition among renters increases, landlords have the leverage to raise rental prices, enhancing rental returns and making property investments more profitable and attractive. Specific suburbs stand out for particularly tight rental availability. Gorocan at just 1.29%, San Remo at 1.48%, and areas like North Gosford and East Gosford are similarly tight. These figures clearly signal strong rental demand, which could quickly translate into rising rental prices and more attractive yields. And lastly, there's the potential for a mid-term inflection from interest rate cuts expected in 2025. Lower interest rates typically reduce borrowing costs, making property loans more affordable. This can lead to increased buyer activity, higher demand, and upward pressure on property values, particularly benefiting markets like the Central Coast, where yields remain attractive and stock levels are tight. Historically, we've seen Central Coast suburbs respond strongly to rate cuts. After the 2015 cuts, suburbs like Gosford and North Gosford surged significantly. A drop of even 0.5% to 1% in interest rates could reignite investor interest, especially in the suburbs priced under 800K, such as Lake Haven, Gorocan, and Bujwoy, where yields remain attractive, averaging over 3.5%. So, is investing in Central Coast a waste of time in 2025? The answer clearly is no. But that doesn't mean every suburb is a buy. The key is matching your goals with the data. Because what matters to an investor looking for strong yield and tight vacancy is going to be completely different from what matters to an owner-occupier searching for lifestyle, schools, and long-term livability. So depending on your goals, the Central Coast offers different opportunities. For owner-occupiers looking for lifestyle, premium areas like Copacabana, Matcham, and Pearl Beach still hold appeal. Despite weaker yields, these suburbs are slower moving right now, meaning less competition if you're a long-term lifestyle buyer. For SMSF investors, yield-focused buyers, or Sydney-based upgraders chasing lifestyle without the Sydney price tag, the Central Coast is still strategic if you look to inland suburbs such as Wyong, Killarney Vale, or Bujwoy. Here, yields are around 3.5% to 4%. Vacancy rates are tight and days on market are relatively short, at around 30 to 40 days. If I had to pick one suburb in each tier to keep an eye on, high would be Matcham because of its prestige appeal and low stock. For mid, Killarney Vale because of its strong rental demand and balanced metrics. And for low, Lake Haven because of its solid 3.85 yield, tight rental pressure, and its sub-800K entry. Here's my final thought. The Central Coast isn't done. It's just in a different phase. And if you know where to look, the opportunities are still there. And if you want help identifying the right suburb, based on your strategy, head on to suburbsfinder.com.au. We've built a data tool that lets you zero in on the metrics that align to your investment goals. I've left a link to a free trial below. See you in the next one.